When Trump got elected, everyone was expecting him to be bullish for the markets. However, we've seen the opposite happen with markets crashing. One theory for why this could be happening is tied to US government debt, but most people don't really understand how government debt even really works. So in the next few minutes, I'll explain a little bit more about US government debt, how it works, what this theory is, and how it's impacting traditional markets, and consequently, how it impacts crypto. So, as I say, most people don't really understand how governments can hold so much debt or how government debt even works. We actually discussed this in my VIP community call last week, as it's pretty hard to get to grips with. Nations around the world are in insane amounts of debt, right? Global debt has reached over $300 trillion, which is an all-time high, and it's steadily rising. And the US is leading the pack with an insane 36 trillion, right? So US has 36 trillion, China's second they have the second largest economy, 16 trillion, then Japan at 10 trillion, the UK at 3.7, France 3.5, and so on and so on and so on. You see there's a lot of debt. For most ordinary people, the word debt immediately conjures up a negative image. We're generally taught to avoid debt as much as possible, and people chronically in debt are seen as financially irresponsible. So why do we allow our own governments to be in so much debt? So the thing is, debt isn't all bad, right? Many people take out multi-decade mortgages to buy houses that they couldn't afford otherwise. As long as they can make the monthly repayments, it can actually be cheaper than renting, and they end up with a house in the end that they wouldn't if they were renting. So there are times that debt can be leveraged in a good way, right? The problem comes when repayments are higher than their income and they find themselves unable to keep up with them. In this sense, governments are no different. Government debt can be useful to finance strategic projects that can make the country grow and prosper, generating more income for the government in the long run. As long as the government debt repayments are not too high, they can keep paying them off and push the problem further out into the future. But what happens when that future catches up to them? Before we continue, if you want to set up your first crypto wallet so that you can take part in the growing global crypto economy, plus access over $1,900 worth of courses entirely for free, then click in the link in the description below. So the US economy is the single largest economy in the world and accounts for a whole 25% of global GDP. That's huge, right? It's a quarter of all GDP is just the US, you can see here. Even China's huge economy, that you can see here, is dwarfed by the US, accounting for just 16%. And the next largest is Japan with only 5.5%, right? And then you get a bunch of the countries from Europe, and you get some of the other larger nations like India, Russia, etc. Therefore, the US's impact on global economics is completely outsized, right? Any decision it makes has huge ripple effects throughout the entire world. However, although the US have a booming economy, they also have the largest debt of all, as we saw above, and their debt is ticking up fast. If you go to this site here, US world debt, it shows lots of, or world debt clock, it shows lots of different, here we go, US debt clock, it shows lots of different data, and you can see the numbers going up in real time. Trump's administration inherited a government with huge debt, and they are fully aware of this, and seem apparently intent on dealing with it, regardless of the financial pain it will cause or the negative impact it will have on the US's global hegemony leadership, right? Large amounts of this debt was sold in the COVID era where interest rates were almost 0%. But now, as much as $10 trillion worth of debt is close to reaching its maturity date and is going to have to be refinanced in the next 12 months. In practice, the debt gets paid off or refinanced by issuing more debt at a newer, more up-to-date interest rate, right? So the important rate that matters here for the government is called the 10-year Treasury yield, because it's based on this rate that the new debt will be refinanced at. Currently, this is above 4%, so the old debt they were paying, which was closer to 0%, is going to suddenly become a lot more costly. Before we can understand what 10-year Treasury yields are, we need to start with Treasury bonds. Now, this whole part gets quite complicated and I could easily just skip over it. But I think the whole point of this video and this post is for people to understand how governments really work. So I'm not skipping it, right? When a government cannot pay their incoming bills, they issue debt, which is known as bonds. In the case of the US, this debt is called US Treasury bonds, or USTs, and are sold through the US Treasury authorized by the Treasury Secretary. Previously, in the Biden administration, this was Janet Yellen. Now, under Trump, it's this guy, Scott Bessent. When the US Treasury issues this new debt, they go out to the open market and other governments and big institutions bid up against each other to buy it up. People buy this debt because the US is the most powerful economy in the world, as I previously mentioned, and has never not paid up its debt repayments. So anyone who wants to put up their money to work and earn the apparently safest interest or yield in the world will buy these bonds. These USTs come in different maturation ages, i.e. the date they need to be paid. They then offer different coupon rates, i.e. the rate that they earn yield at. The most important USTs and most regularly sold are the 10-year treasuries. In other words, the ones where the government will need to cough up the money in 10 years from now, right? And they'll keep paying that interest for those 10 years. The current yield earned in the secondary market for the 10-year treasuries essentially marks the rate that the US will need to pay to refinance their debt. So this is a key thing. It's not the rate that they released when they sold the bonds. It's what's currently being paid in the secondary market that generally fluctuates, and that's roughly where they end up being able to sell the new bonds at. The government bond market is complex, but as I said previously, USTs are considered the safest place in the world to earn interest, right? So when world markets are in turmoil, people buy USTs, even if the turmoil is predominantly caused by the US government itself. As the demand grows for USTs, so does their price. This is just simple demand and supply. And the higher price for bonds means lower yields on bonds. This is slightly complicated, and it can be often hard to understand. But if you follow along, it's not too complicated. Essentially, bonds have an original price and then what they call a coupon rate that they are given when they are sold, right? That's key. So let's say we have a $1,000 bond, for argument's sake, that has a 3% coupon rate. That means it will return $30 per bond per year. That's 3% of 1,000. The bonds holder will earn that steady $30 payout from the US government regardless of the price that they paid for it or that they potentially bought it on the second-hand market, right? Either they bought it directly from the government or on the secondary market. Now, when the demand for those bonds drops and people sell their bonds, right? Say the market's going well, people decide that they want to earn more interest, so they sell the bonds. The price could, say, drop because there's less demand, they're all selling, and the price of these bonds could drop to like $500 per bond instead of the $1,000. So its yield rises because it's earning $30 per year regardless, and it was bought at $500. So 30 divided by 500 is 6%. It's earning a 6% yield. But when demand heats up for the bonds and the bond's price goes up, the price could, say, rise back up to, for argument's sake, $750 for that same bond, making the yield drop. So, 30 divided by 750 is 4%. So it started at 3%. The market sold loads of bonds. It went down to 6%. The price went down, but the yield went up to 6%. And then loads of people wanted to pile in and buy bonds again, and the price went up and the yield rate dropped to 4%, right? So that's a crucial concept. When there's demand for bonds, the price goes up and the yield that you earn on them drops, right? So Trump has actually gone on TV to say he wants to reduce the 10-year treasury yields because he knows it'll influence the rate of that $9 trillion in debt that needs to be refinanced, which we mentioned before. This is him saying in an interview that they were saying the market's gone down. He says, yeah, but in the meantime, the rates have gone up. The rates have gone down as well. His goal is to get the interest rates down. But to reduce this yield, right, he requires growing bond demand, which usually comes from either the Fed reducing interest rates and or people wanting to de-risk their money. People de-risk their money when they fear recessions or geopolitical unrest, and Trump's certainly stoking those fears right now. Plus, the Fed will only reduce the interest rate when they see that inflation's back below their 2% goal. And it's been over 3% for a long time, and the last number came in something like 2.8%. But Trump's policies appear to be helping this happen, as trueflation, which is a known marker that tries to kind of predict the current inflation, not the past inflation, is saying that inflation is down to 1.3%. And all of this is indeed having the desired effect of growing demand for bonds and reducing 10-year Treasury yields. It's working. Now, am I saying that Trump is intentionally causing unrest in the market? Well, potentially so. I mean, I can't read his mind, and he seems to flip-flop on things all the time, right? If this is indeed what Trump and his administration are attempting, and this is a big if, as I can't read his mind, then it is a risky bet to play. Firstly, the world's never been more in debt. Sure, US debt is at huge levels, never seen before, but at least against its GDP, right, as a comparison with the size of the economy, it's only 120%, right? I mean, it's still a huge number, but it's only 120%. When you compare that to Japan, that's at 260%. It seems small, right? But it's still one of the top 10 largest, even in terms of the GDP ratio, right? GDP to debt ratio. In the past, we've seen scenarios where individual governments were over-leveraged, but never so many countries at the same time like this before. It's an unprecedented moment for the world. If Trump's administration continues causing this turmoil, it could kick off a recession in the US that could theoretically kickstart a larger recession around the world. The simple possibility of this being true can also help to generate a self-fulfilling prophecy and make it happen, right? However, although the stock market, it's not all bad, right? Like, this is just, the risk, right? And that's what's made the stock market crash. And it's crashed down, the S&P down over 7% recently. I mean, that's really quite a drastic amount in a short amount of time. But even so, it's still up over the last 6 months, slightly, but it's still up. And all the other economic indicators in the US seem generally strong, with inflation coming down, as we mentioned before, and unemployment rate at historic lows of 4.1%. I mean, you can see kind of history of it. This is really good. Like, the US unemployment rate is really good. So the most likely outcome is that there will just be some pain in the markets until the economy gets past this rough patch. And if there is a recession, it will be a short-lived one. That's the hope, right? And if we don't see a recession, or if we do see a short one, then and all of these things come to fruition, it could be good for the US in the middle to long term. Just because Trump's administration are firstly cutting costs with Doge, supposedly, while increasing revenues with tariffs, and generating more internal business and investment with lower income and corporate rates coming up, right? So if the incentive is to do business inside of the US and the government is cutting costs, then that will be really good for them. The US government has a spending problem. This past month of February alone, they spent $603 billion while they took in $296 billion. So they're spending 2 times what they're earning, right? Rebalancing the government's income and expenditure is essential to getting their debts to more manageable levels. And you can see, just how much they're spending on interest, social security, income security, etc., right? This was just coming in through taxes and through other things, but they're just spending, they've got a huge deficit. And with this deficit, they need to, get more debt and create more debt and more debt and more debt. So, making the US more fiscally responsible would in principle be an all-round win for the US, right? And there's no doubt Trump will want the markets to be strong by his midterms 2 years from now. So hopefully this pain should pass. So how does this affect crypto? I've spoken predominantly about traditional markets and more broad economic concepts. Well, crypto is considered a risk-on asset, which means that when people have an appetite for risk in the market, it will do well. But when people are fearful, the crypto market tends to do badly. It's still very tied to the sentiment of the overarching macroeconomy, right? And since traditional markets are having a terrible time, this has spilled over into crypto. There are well-known fear and greed markers that have been stuck at extreme fear for the past few weeks in traditional markets, and that's brought fear and the fear down as well, like an extreme fear in the crypto markets. Now, while people were expecting a really bullish entry for Trump, he's had the opposite effect, at least in the short term. However, although things look ugly in the short term, it's important to note that the overarching crypto news for the US government has never been more bullish. The SEC has dropped their ongoing lawsuits against companies like Coinbase, Kraken, and Consensus, and last week they announced a Bitcoin strategic reserve, which was huge, and the White House even had a crypto event with lots of relevant figures from the crypto space in the US. For someone who's accompanied the market for like 9 years, I've never seen such bullish times in crypto. If you can weather the storm, you'll surely make it out the other side. And this is a nice meme. What people think it's like to hodl, it just goes like that. But what it's actually like is full of peaks and troughs, right? Now, many people connect M2, which is a measure of global liquidity, to the price of Bitcoin with a lag. And we've seen a drop, but it's on its way back up. But understanding M2 is a whole different topic for another day. The point is, positive things should come soon. So if you have a solid DCA strategy and portfolio management, then you should welcome this moment as a great opportunity to buy the dip, because it too will pass, and crypto's tailwinds have never been stronger. And if you want to have a better DCA strategy and portfolio management, then follow up on those posts or send me a message, join my community, and we can help you out with that. And if you want to set up your first crypto wallet so that you can take part in the growing global crypto economy, as well as what I've just said, and access over $1,900 worth of courses entirely for free, then click the link in the description below, and I'll see you there.